Yo, yo. Yeah, yeah. What's up?
Going on?
Nothing much. Excited for the day, for the power hour and stuff. Just hanging out. It's been an interesting day. But yeah, nothing crazy. It's weird that tomorrow is the end of Q2. We're in the middle of the year. Just weird times going on, but yeah, no, excited for the spaces today. Should be a
Does
good
it
one.
not does it not feel like we're halfway through the year?
It's very nice out. I'm just hanging out outside right now, so that feels good at least. Maybe it does, maybe it doesn't. Just time's feeling weird. But I'm feeling fully back from vacation though, which is good. Took a day or two, but that's nice.
It's good.
Amazon, stock talk. We'll probably talk about that one. She's been doing pretty good. I want to maybe
Amazon.
talk about that Tom Lee call that he made a little bit.
Okay, you wanna outline that a little bit further?
No, we'll wait till we get more people in here. We'll talk about it later on.
Okay, no problem.
He said
What's
15K for the S&P 500 by 2030. It's at about like 5,500 right now.
got it. What is up, George? How you doing?
I don't
You
hear
got George
anything.
up?
Yeah.
No, I don't hear him either. All good. All right, we'll give that a second. All right, I can walk through some of what I'm looking at right here. It is a mixed day when it comes to the indices. SPY slightly red, down just about 19 cents. Q's slightly green, up about 93 cents. Outside of that, the only thing that's probably weighing it down is Nvidia, down about 1.4% today. But most of the rest of the stuff is very slightly up, besides, I guess, Amazon, which is up 2.28% today, just going wild continuously. I was looking at these leaps yesterday. I'm sad I didn't take them. They went from, or well, they are already up 57%, 250 hours contract. Wish I took those, but Amazon just not stopping. Just going for 200 is what seems to be the plan here as it continues to crusade. Looking outside of Amazon, rest large cap tech, nothing, like I said, moving too much. You've got Google up about 0.7%. You've got AMD up 1.5%, Apple up 0.25%, Microsoft up 0.17%, Meta up a percent. So not huge moves, but green for the most part across the board as we're looking across it. Outside of that, crypto kind of rippied a little bit today off the news of companies filing for Solana ETFs. I think that's what was driving most of that. You did have a very good day with CrowdStrike and other data
What
related
was that
plays.
thing? What was the thing with Coinbase like suing the whatever? I'm sure you saw
Uh,
that SEC and stuff like that.
I didn't even look into that, to be honest.
Oh, okay. Well, I didn't really either, so I guess do your
Okay,
homework and let me know.
I'll have to take a look. But we can get rolling around here. There's some folks on stage that I'd love to hear from. We can get into it. I get more opinions as we go throughout. But Dimitri, it's good to have you back up for this Thursday. I saw that you guys did a geo space the other day. So it looked good to see you guys doing some of those. Curious to hear what you've been talking about, especially with everything going on in Bolivia.
Yeah, for sure. Well, first off, thanks for having me. Sorry I haven't been at the last few sessions. Things have just gotten really busy. But yeah, the last session last night wasn't about Bolivia. It was about the future outlook for India economically, geopolitically, and financially. And Stock Talk, as we all know, is very bullish on it. So it was interesting to hear his perspective. But yeah, no, it was a really great session. Before that, I think we did a talk on de-dollarization, which was hugely popular and a personal favorite topic of mine. But yeah, it's been going well. As for Bolivia, it seems to be a nothing burger because the coup essentially failed, and it was a pretty short-lived one. In my view, there does seem to be some obvious political instability there, right? If you have a coup, it's hardly a bastion of political stability there. I think what's interesting is their place in the lithium triangle in Latin America, along with Argentina. I'm forgetting the third country. It's at the tip of my tongue right now. I think that makes for a much more interesting story vis-a-vis the energy transition. But yeah, that's kind of been what's going on there. In terms of more market related stuff, I have a couple of thoughts, and I actually really wanted to hear from the panel because I have a genuine question I'd really love to hear everybody's opinion on. But first, a couple of thoughts I wanted to put out. So, if you guys aren't following Game of Trades, he puts out really interesting content, like really great charts. And some of the stuff that I've been seeing recently is that we're seeing a depletion of pandemic era savings. And that's something I've been talking about for a while. Talked about credit card debt hitting, for small lenders specifically, hitting really high levels, exceeding previous recessions. And as we saw, right, retail sales, they were just up 0.1% in May, but that was below the 0.2% expectations put up by economists. At the same time, you're seeing that the current rate of permanent job losses are actually accelerating at a rate somewhat comparable to the two recessions I mentioned above, like the dot-com bubble and '08. Tomorrow, in terms of economic data, we're getting core PCE and U of Mich sentiment data. I imagine consumer sentiment will probably come in weaker than expected. As for PCE, I think obviously it's very important. The Fed said they would, consider raising rates if they saw inflation moving sustainably lower, and they keep using that word sustainably. And the implicit understanding there is that there's a consistent downtrend in inflation. So unless we see that, that obviously is going to have big implications for rate cut bets. Obviously, the big circulating data point that we've been seeing is new home sales are down 11.3%, with supply reaching a 16-year high. That percentage-based drop, I think, was the biggest we've seen since September or October of 2022. As for the job market, which I've been finding very interesting because the anecdotes are beginning to pile up more, I read that the California job openings tumbled close to 50% in the past 2 years. And you have to remember, California is the world's fifth largest economy. So, in my view, that's kind of a bit of a canary meet coal mine situation. You do have to account the fact that a lot of tech and finance is in California. So, those industries were particularly hard hit by the Fed. So, obviously, that may be skewing it a bit, but I do think there's something there. And Powell himself said that payrolls data may be actually overstated. NFPs may have been as overstated as, like, I think it was like 730,000 jobs just last year alone. And there's some reports coming out that's saying that hiring was even falling below zero in October. With that all in mind, obviously we've seen Nvidia, become the most valuable company before shaving off $500 billion, but maybe that's more of a sell in May and go away thing, except extending into June. But something I'm curious about to hear from the panel with that prelude, and I'm genuine about this, is why do markets continue to climb? Because is it primarily a function of great earnings from Nvidia and the Magnificent Seven holding up the rest of the S&P? Because at the beginning of the year, there definitely was a reason to be bullish, right? You're not going to get a recession, inflation's going down, and we're going to get rate cuts. You could not come up with a more bullish story. But all of those are cracking now. And I guess the next thing you could say is, well, we have look forward to earnings, which have been stellar. Okay. But earnings are a function of a strong consumer, which we are seeing weakening. So my question for you all, my question for everyone here, because I don't genuinely know it, is what exactly are markets trading higher on? If it's not earnings, and if it's not those three factors I mentioned earlier, what is it?
George, what do you think?
I mean, this is probably a fairly George answer here, but I think it's on AI. And like I can give a specific number that I was just wanted to take a look at as you were talking, because I think I agree that the macro story isn't fantastic when you look at, I think, especially the consumer spending stuff, that it looks like they were going to have to pay the piper on eventually. But if you look at, and I look at, Vanguard, small cap growth, small cap value, mid cap growth, mid cap value, large cap growth, large cap value. Every day I have a table that just like kind of helps me along with the sectors. And if you look on the 3 month, small cap growth is down 4%. Small cap value down 5.4%. Mid cap growth down 2.46. Mid cap value down 3.53. Large cap growth up 9.29. Large cap value down 1.78. So I think if you look at the last 3 months, the answer is the market isn't really going up or isn't going up other than large cap growth. And I think large cap growth is the best proxy for AI because you have both the comms giants, Google, Meta, as well as the the tech companies that everybody would think of in there. So I think that that's what I've been looking at, and I've been, kind of betting on it all year, having a very good year, on, AI and that proxy large cap growth that I continue to look at to make sure that to kind of check in on the health of, what I think are the AI bets. And in terms of like, the question of is it profits? Like, yeah, I mean, I think we keep on seeing, revenues, profitability going up, kind of, especially with like Nvidia being the biggest story, going above guidance, guiding up. So I think that is still on the upswing. Profitability is still on the upswing, for these AI companies, and something that I think we could see to close out the year, maybe even the next year or two. I think we can see an economy that does face problems, does face consumer spending challenges, but the stock market goes up because AI continues to be so strong. So that would be my answer to that question. But one other thing I just kind of want to put as a topic is, I'm actually seeing comms, communications becoming a more exciting sector. I saw some weakness and obviously starting to see it turn around. And Google's been something that has now become, I'd say probably my favorite stock in terms of risk reward, especially because it does trade at a relatively low PE. I think maybe the lowest of any Mag 7 stock, and is obviously a great AI play. And I think they'll start to sort things out more and more there. But yeah, I think that I don't think we're necessarily seeing a healthy market outside of AI.
Right. So it sounds like it's, I guess, what you could call residual or ongoing not euphemism, pardon me, euphoria about the AI boom and all the prospects that
Yes,
brings. So
I
that
think
seems to be
there's
the
some.
story. Okay, that's interesting.
Yeah. I think there's some overplaying of that, like in terms of the euphoria thing, but I also think there's very real profits and very real guidance going up, not for every company. But enough of them that, I'd say where guidance even is getting raised, that I think people are kind of saying, okay, there might be more real profitability here in the short, medium, and long term than we even thought. But I agree, there's some overplaying of that, but unlike, kind of bubbles, I do think there's real money going in and real money being forecasted by the companies that are the biggest players in the space.
Yeah, Bill Gates did an interesting interview. I just saw like a clip of it on X, and essentially they were asking, "Do you think Nvidia is overvalued?" And he was saying that what was it? He was saying that Nvidia and its market value is not the same as like Pets.com in the 90s. Like Nvidia, like you said, has very clear good prospects given the high demand for AI that a lot of companies are adopting and a lot of consumers are using. So I can definitely see that dynamic playing out there, which makes sense to me. But also, like, I also want to make it clear that, like, just because the economic data may be weakening, it doesn't mean markets can't keep climbing higher. Just for me personally, as someone who does like not short-term trading, but more long-term investing. Obviously, I look at pockets to cash out. It is just a little bit strange that there is this huge disconnect. So for me, that's why, as like someone who's investing, it made me a little bit nervous, I guess you could say. But obviously, I'm not complaining. My portfolio, along with everybody else's, seems to be going up as a function of this market's resilience. So I'm not complaining, but rather just trying to understand what exactly is that's pushing it higher.
Yeah, logical.
Yeah, I mean, I think it's kind of part of what George said. The market is very much market cap weighted. We know Nvidia. The latest news has been it's been the largest company, and then you have big concentration in the S&P. But that's not generally bearish or anything. That's actually a sign of bull markets. But I think if you ask, where does the market go next, and George kind of alluded to it, but I don't think he made the point that I would make, which is I think that we would see the rest of these things that have been not participating begin to catch up. And the reason for that is because you mentioned, earnings data, and then you say, well, if the consumer is going to weaken, then why wouldn't the earnings weaken? Like that might happen, right? But if you choose your spots, I think that there's going to be a lot of businesses that are still growing. And I think that if you look at the valuations of a lot of these names that have not yet participated, like if you look at like the S&P 493 or you look at IWM, I mean, maybe not all the unprofitable zombie companies, but generally speaking, smalls and mid caps are at extremely low relative valuations and historic valuations. So I think what I would say is like I was making this point on the spaces. I think it was yesterday. It's like fundamentally, at some point, you can't ignore the deals on the market. If you are an investor and you have cash and you need to invest, and for instance, let's say rate cuts come, right? Now all of a sudden the risk-free rate comes down to 3.5%, 4%. It's not 5.3% anymore. So you're gonna want to do things with that money. You're gonna want to find growth in this market. I think there's still a lot of companies that are coming off of their trough revenue. I think a lot of companies did still see a bit of an earnings recession in 2022, and they're just now recovering from that. Meanwhile, their valuations are still looking pretty reasonable, and we can expect that their earnings moving forward are going to be pretty strong, which makes their which makes the multiple that you're paying on these businesses more than reasonable. So, yeah, I think you just think about it. You're in the market for a house, right? Like if the average cost of a house is $600,000, but a house goes up overnight for 480, I think it would probably sell immediately, right? And so I think there's just at some point where price can't be ignored, and I think that there's still a lot of quality trading for below fair valuation at this point in this market. And personally, that's where I spend a lot of my time. It's obviously not fun when it's only a few handful of stocks going up, but nothing lasts forever. There's rotation all the time in markets, and momentum and chasing has been working well. We could probably just see the S&P climb a lot slower, but equities don't really fall, and instead maybe we see rotation out of certain names or certain sectors to chase laggards, and maybe we have some sort of catch up trade. And so ultimately, that's kind of what happened in 2022, right? Like energy was working so well, and money was flowing out of tech to go into energy. And ultimately, while you had Amazon down 55%, Meta down 70%, the S&P only saw a drawdown of 25%. And that's mostly because a lot of the money is not really leaving equities; it was just going from one sector to another. So you can still see the S&P hold up okay, as long as there's bids coming elsewhere, even if some of the leaders end up consolidating for a while.
Shai, you got thoughts here?
Yeah, I mean, I think B2B is just driving this rally specifically because of that potential innovation that AI can cause on the enterprise level is is pretty wild. Where the efficiency will be drastically different than what it is right now. So the potential of being able to do the same type of work with, I don't know, like a 30% reduction in expenses, that's a huge mover for a lot of enterprises. So I think that B2B is kind of where you're seeing what's driving the market, like the Microsofts, Amazon has a B2C component, but really AWS is killing it. That's what's driving it as well. And also all their AI initiative, that's more B2B. So I do think you're seeing that the consumer's struggling. Like all the major retailers are just every retailer that's reporting their earnings recently, like you show the consumer weakness. And I think the consumers, the B2C type of businesses makes reflect the most similarities to what we're seeing in the economy. Where B2B or like the big tech companies and the enterprise level, like you won't see that same kind of correlation. And I think that's what's really causing discrepancy between stock market and economy right now. But again, I'm not a macro person, I'm very micro, but that's just like my 2 cents of what I'm noticing. And there's only like ten names that are kind of driving this market, and they're primarily B2B. And I think that's why we're seeing like all-time highs after all-time highs when in reality, the macro data is absolutely getting worse and worse for the consumers.
It's very interesting points. Dimitri, any thoughts on some of the takes we've had?
No, like I said, I was just genuinely very curious to try to understand people's perspective. The AI narrative was an interesting one. The B2B innovation space vis-a-vis AI that Shay was talking about was also an interesting perspective that I hadn't incorporated in my analysis. But yeah, no other thoughts. Very, very interesting. And I was genuinely curious because I was trying to figure out like what's going on. Obviously, like I said, everyone's portfolio is, probably pretty happy right now. My only sort of question, and this is, I guess, where sometimes it becomes an exercise of futility, is when do we see that not correction, but I guess a correction, or rather that collapse between where people think the market's going and what the underlying economic reality is. And my guess is that the economic circumstances have to get so bad that you just can't really ignore them anymore, and they have to start showing up in other areas within the financial sector. So, but like I said, up until that point, I mean, what's that expression? Like, keep dancing while the music is playing, so to speak. So, with me, like I said, I do more long-term thematic investing. So, generally, with these kinds of things, I just try to analyze. Okay, does this look overpriced? Does this look well priced? And then sort of make my trades based off of that, framework. But yeah, no other thoughts. Thanks for having me. Always great to be here.
Yeah, absolutely. I appreciate you starting us off with that point. George, what else is standing out to you in this market? You had mentioned wanting to continue riding large cap tech, and that has really worked. Have you added anything else into that investing repertoire?
Yeah, I mean, I think I briefly mentioned Google as a new thing that that I have my eye on as like probably like my favorite long in terms of what I think its potential is. I'm also looking for I don't know if it's because retail, like consumer discretionary, like got too beat up. I'm still kind of wondering what this resurgence is about. But on the consumer discretionary side, two stocks I really like are Booking, BKNG, which I just added this week, and then also Mercado Libre, Melly. Those I haven't added that yet to my investing portfolio, but I've got my eye on it. And the other one I really like as a tech play, as I'm seeing like riskier things in the chips. And these are all obvious, but this is kind of the space I play in. Microsoft. I think that traditionally Microsoft has not looked good in Prospero signals, but it has looked really, really good lately, and I can see why. I think there's a lot of fear around, I think, chips specifically, but something in the tech sector that still has, a lot of, I think, as mentioned, B2B growth opportunities, and is just like, kind of the AI moonshot. I think people are going to continue to buy Microsoft, and kind of Google's in the same category, even if there's more fear around valuations in the chip space.
Logical. What do you think? I know that Shy, sometimes I usually go to him for more of those conversations, but I'm just curious to get your thoughts on that chip space topic.
Look, I'm not really the person to go to for the trips. I feel like I don't even know what to think anymore, right? Like it's been historically a very cyclical sector, but I know, Stock Talk's been talking about how it's more secular now. I always believe in the secular nature of it. So, but maybe now the cycles are actually going to become a lot more they're going to become a lot longer. It looks like, if for instance, Micron is coming out and they're talking about, increasing capex by a whole lot for next year. That means that they need more capacity to meet the demand. Now the question really becomes, though, what's very popular in these cyclical industries that are capex heavy are that you get like this big pull forward in demand. You build out that capacity, and then as soon as it's built, it's like the demand kind of falls off a cliff. So maybe that will trigger the next cyclical nature of the chip companies right now. So yeah, I don't know. I'm not fully convinced that we're not going to see big booms and busts still in this sector, but who knows?
Shy, you got any different opinion there?
On what's happening to chips right now, or where to go into it.
Well, I guess, George, can you reiterate kind of the final piece of that point?
Oh yeah, that I think that we're just seeing, like, I'd say a lot of the retail fervor for these chip makers starting to soften, as well as more narratives around them kind of being overvalued, and we're seeing a lot of back and forth versus
Mm.
what I would say is more like unabashed bullishness that we've been seeing to start the year. So like I always like to see the narrative around things, and I think that narrative is softening. So basically, for risk control, instead of playing chips as hard as I've been playing it, I'm looking for, tech adjacent stocks, whether it be comms, whether it be a tech stock like Microsoft that has like a much wider, like especially B2B base. and a much like, I would say much more, diversified business than just being dependent on, kind of the AI boom around especially chips orders. I think that's specifically my thesis right now.
Yeah, so what George is saying absolutely makes sense. I think the back of every investor's head entering the hardware space, which there's a lot of new investors getting into semiconductor names that didn't at all 5 years ago, so I call them new investors, is when am I investing at the top of this cyclical trend in the thematic within the hardwares? That's always gonna be a fear of people's head because I do agree with stock talk. Like I do think this specific industry will eventually tilt towards secular, but there is gonna be an awkward period before that happens. And this pull forward demand that we're seeing in the hardware space, you're seeing the evidence of it with the primary weight of the IT budgets for a lot of these big tech names are going towards the AI infrastructure investments. That's not going to be permanent. That's just trying to fulfill all the demand that they're anticipating. It's a bunch of upfront costs that they're giving that results in the revenue for these hardware names that won't be recurring for the next couple of years, or it won't always be recurring. So the fear is like, all right, once they have all the necessary infrastructure side of their business, like they're not going to continue spending the billions and billions of dollars that they have been until they see some validation that AI is going to cause an ROI in their business, or that the demand is going to continue, and this is in fact an AI revolution, not a blimp in like the pull forward demand. So because of that, the way the semiconductors have run, the hardware names have ran, I do see, especially the past 2 weeks, like if today we finished running SMH and tomorrow, unless there's a massive green day, we're gonna have back-to-back weeks on the weekly chart for the SMH of being red. That's only happened one time in the past 7 months since the October rally. So I do think there might be, as Q2 is coming to a close, we could be witnessing a potential like mini rotation towards sectors that have recently underperformed or have that recurring revenue natured into their business model. Like Microsoft will absolutely be one of the biggest beneficiaries of AI, and they have a recurring revenue business model. And OpenAI is clearly the first mover advantage in LLMs, and they are just like the perfect picks and shovel play for a lot of other companies right now. Like that's a safer way of playing than I don't know, maybe predicting how long the pricing power Micron's going to have, or Nvidia's GPU advantage, like how long that's going to maintain, or when is software or the platform revenue going to be more of a weight in Nvidia's business model. So now it's going to be more recurring than less cyclical. Like there's a lot of unknowns in the hardware space of how long this upfront cost or AI related investments will last. And there could be a fall to safety of like, I want to still participate in this theme, but I want a exposure in companies that have a recurring revenue nature, like Google's, Microsoft. So I also think that there might be a mini rotation towards sectors that underperform, like I called out before, were like the high quality growth software, or even the fintech names who've been lagging due to macro driven causes, like business spending is still not recovered the past couple years. Higher for longer narrative is kind of killing the fintech companies, and also there's a lot of uncertainty in that industry on competition, etc. But they are all very undervalued, and eventually they will catch a bid, in my opinion, especially as a vehicle to capture alpha on any kind of rate cut narrative. So do see a potential mini rotation away from the hardware names, but that doesn't say that everyone should sell off the Nvidias, the ASMLs, the TSMs, the Microns. Like these names will have pricing power for quite some time. I just think they're going through probably a cool off period of consolidation, and maybe people don't want to sink their or keep their cash. Start factoring in opportunity costs and want to rotate that cash into the lagging names who are high quality or will benefit that same theme that isn't as risky as potentially investing in a cyclical industry. So hopefully that answered your question, Galbert, and also the listeners.
Got it. Thanks, Shai. All right. Pretty interesting points here. And I think that it all makes sense. These are the number one things that people are talking about when it comes to things propelling this market. Evan, I know you stay on top of it pretty closely. Do you have any opinions on sentiment potentially changing over the last couple of weeks in regards to retail, and or is this just a small pullback before the next leg up?
I don't think sentiment has changed at all. There you go.
So, George,
Short and
what are you
sweet.
specifically seeing that makes you think sentiment has changed?
Sorry, was that to me, Gov?
That was to George.
Oh.
Yeah. I'm mainly seeing softening in options sentiment. That's the main thing that I'm seeing. I'm just seeing like less bullishness on a variety of the chip stocks. And that's even when QQQ net option sentiment is staying very, very high. And that's like what's behind my narrative of switching to like other tech, because there's no other reason than just like I would say like uniformed lack of the same kind of enthusiasm for chips for option sentiment kind of across the board across many of these different chip stocks, kind of being at lower levels than it traditionally is. Like Nvidia especially was like locked at 100 since like I think for the last um I want to say like 4 or 5 months, and it's been going down. Um, so that is one I'm looking at. I've seen like a lot of I've seen a lot of, I mean, my Micron for obvious reasons. I've seen ASML going down. I've seen LRCX going down. It's just telling me that there's just less appetite to bet on the growth of these stocks based on those options metrics.
And Evan, you're not seeing that?
I don't look at options. I mean, I feel like I don't look at options and stuff like that. Could very much could be right. I have no idea. I think this is still a bull market. Market is still clearly bullish. The areas that have been leading might have been rotated around. It's maybe a different bull market, but yeah, no, it's not something I look at. Wolf.
Yeah, Sniper?
Comment to me on that.
Is the thesis for your previous statement based off of options flow, or what is the thesis for making that claim? I'm just curious.
So my company generates a net option sentiment rating. It's a combination of um, basically our own take on skew. We look at one of the things we look at is like momentum of spreads. And we kind of like the core of that metric is kind of like what I would say is the opposite of a sweep order. So instead of like a concentration of a single like strike expiration, some like institution getting an ROI on basically sending that message. What we're more looking for is robotic signatures and consistency across like lots of different strikes and expirations. And we scale that, roll that all up into one number. And basically what I was just quoting was looking at the decline in that scale of a bunch of different chips, stocks.
I see. I missed the part where you were talking about chips specifically. I thought you were talking about the market collectively, as in the whole S&P.
No, just I'm actually, yeah, just the chips. I'm seeing weakness, and I'm seeing weakness actually relative to QQQ net option sentiment, which is kind of how I look at obviously the tech market as a whole.
I could say that there's been heavier arbitrage days. On QQQ, we have 46.5% neutrality today, which is unusually high. But I mean, the bull and bear premium is pretty similar. It's 26 to 27%, slightly more bearish on the Qs versus SPY, though the bull premium is still taking over.
I'm talking about I'm kind of talking about the trend. I don't know if you're like what I'm seeing like the last few weeks, month. I don't know. I don't know if what I don't know if that's what you're speaking to as well. But also I don't really tend to look at much else other than what we produce. It's a pretty effective metric. And I think a lot of other metrics are highly ineffective. So I don't actually know what you're referring to, but I I uh, I don't tend to like. I built our metric because I found all of the other ones to be, quite frankly, useless.
Got you. I'm not disagreeing with you. I'm just saying what like everything that I said was based off of SPY and QQQ flow. Data from unusual whales. I'm not disagreeing with you at all. I was just curious for how you're acquiring these metrics.
Oh yeah, I mean we make them ourselves. Like I was explaining to you, like basically like the core of it. But it's basically the main thing that we're looking at is the consistency of um, you know premium paid to calls above where like QQQ is trading versus puts below, and then we scale that against the rest of the market. But it's obviously like it's a more complicated calculation than that. Um, but that's the core of it. But basically like what we've observed as we've built it is there tends to be a lot of barbelling that takes place to actually like impose certain images on metrics that a lot of other people tend to use, and I would say especially open interest I find to be completely useless as because of that. um, but yeah, what we are looking for is basically rewarding consistency and lack of volatility in terms of, or lack of space in the spread as well as volatility. Rewarding those and creating our own metric out of that. So it's not necessarily going to be a parable to anything else that's out there. Um, Other than maybe some skew metrics, but obviously I'm saying what we're doing is pretty different than that. So yeah, it's often not going to look the same. And I mean, the QQQ has looked pretty bullish, and we were actually like very much out in front of, I would say, the latest move up. And that metric really helped us. Um, but yeah, it's not necessarily gonna like something like uncertainty, it's not gonna pick up because we're just really looking at like a bull, like a net bull bear rating for every stock relative to each other, and some ETFs obviously.
Let's keep it moving here. Evan, what else is on your mind?
I don't know, man. You can't fill out the whole hour? Struggling with the topics? Was it a slow day for you?
Oh, I figured you had something. You had messaged me you wanted to talk about something.
No, I didn't.
You said, well, I mean, I can read it out. It sounded like you had something you wanted to talk about, but if not, no problem.
Nope.
We can. Okay, wasn't sure. All right, so let's talk a little bit about the crypto side of this. Logical, can you roll through for me your thoughts on the Solana ETF filing, and is this just more liquidity for the ecosystem, a short-term burst? Is this bullish for Coinbase? Who does this affect?
Yeah, I mean, it's just tough to know what's going on anymore, because I think I just saw news that Coinbase was like suing the SEC today. It's just a mess. And right now, I just sort of feel like a Solana ETF is, I feel like maybe a step too far for right now. I mean, what's to stop all these other cryptos from launching, an ETF essentially, or I guess funds launching their own ETF for all these different cryptos. But it's, it just kind of is starting to make it seem a little less serious. The Bitcoin ETF was already a step in the right direction. The Ethereum one, okay, yes, that's like kind of solidified right now because, these are the two pillars of crypto, which are, proof of work, proof of stake. They're really proving out the crypto use cases in the world. Um, maybe you can look at Bitcoin as kind of more of that like digital gold piece, and then you look at Ethereum as more of the utility token, and having all these applications built on top of it. Solana is very much a retail playground at this point. I mean, there are benefits to launching new things related to Solana and generally the ecosystem. It is, I believe, the third largest crypto, but I just don't want when the sector is making so much progress, I don't want it to get pushed a little bit too far into a point of like non-seriousness and or silliness, because you don't want. I mean, sure, there's going to be retail always gambling like there is on GME and stuff with all these meme coins, but you don't want major institutions to start getting to that point. I think it just starts making it seem like, okay, yeah, this is all kind of gambly, and you don't really want to be associated with it, right? Like until I start seeing more use like Solana use cases, I just don't know why we're going this far. I think Van Eck is just looking to, increase assets under management, have another product to offer, differentiate themselves. I don't hate the player, but I don't want them to ruin the game. So yeah, I mean, will this get approved? I don't think so, not yet. The Ethereum one, we now that they're no longer pursuing is Ethereum a security, kind of opened the door for that, and then now they're just trying to get in as many things as they can, But once we start getting Dogecoin ETFs, it's starting to enter like a very silly point, and yeah, I think just with all this progress, it's a little backwards. So not looking forward to it. I think if anything, and I'll give a little bit of my thoughts just based on what I've been watching in the crypto sector, because I've been trading a lot of these coins, as you know. I actually have exited all my coins, and the reason for that is I'm not necessarily bearish, but look, there's a new coin being launched every 15 minutes. They're all piling in. It's just
What's my special coin for the debate tonight? Come on, I know you and Wolf. I gotta have at least one. Come on,
Bowden.
Wolf. What coin am I saying? If one of them says something,
Is it Tremp or Bowden? It's got to be one of those.
Depends how much money you want to lose.
Look, I just feel like the debate today will be really fun to watch, but which is not what you want out of you don't want it to be entertaining or amusing, but it is, frankly. But anyways, look, I've been trading a lot of crypto. I traded a lot through the last crypto cycle too, and I saw all of these different coins popping up all the time. And the thing is, it still feels like it's very native heavy. So it's like all these crypto natives, and they're all trading amongst each other. And early on, maybe February, March, April, the sentiment was, we can't wait for